Hey everyone, and welcome. Today, we're going to break down one of the wildest and, honestly, most interesting patterns you'll see on a chart, the broadening top. It's a clear signal of high volatility and some serious disagreement in the market. But for those of you who know what to look for, it can also be a field of opportunity. So let's jump in.
So the easiest way to picture this pattern is to think of a megaphone. See how the price action gets wider and wider over time? It's almost like the market is getting louder, shouting with uncertainty. What you're literally seeing is a tug of war, where both the buyers and the sellers are getting more and more aggressive, pushing prices to new extremes on both sides.
All right, so here's what we've got on tap. First, we'll cover what this megaphone of indecision actually is. Then, we'll give you a checklist so you can spot it yourself. We're going to dissect a real-world example, crunch the numbers on performance, and then wrap up with some actual trading tactics you can think about. Okay, let's start with the basics. When you see this megaphone shape forming, what is the market really trying to tell you? So in simple terms, a broadening top is when you see prices making a series of higher highs and, at the same time, lower lows. That's what creates that widening megaphone look, but the why is what's really fascinating. It means the market is completely split. You have buyers who think the stock is a steal, so they keep pushing it to new heights. But every time they do, sellers jump in thinking it's way overvalued and slam it down to new lows. It's this escalating conflict that creates all that volatility.
Knowing what it is in theory is great, but spotting it on a live, moving chart, that's a whole different ballgame. So let's put together a little field guide, a checklist you can use to find these things out in the wild. Here are the 5 things you want to look for. First, this pattern usually shows up after a nice upward trend, so look for that first. Second, start drawing your trend lines, one connecting the higher highs and one connecting the lower lows. They should be moving away from each other. Third, and this is key, you need to confirm the touches on those lines. Fourth, take a peek at the volume. It should get heavier as the price swings get wider, which confirms that battle is getting more intense. And finally, number 5, you wait for the breakout. That's the moment the price finally escapes the pattern. And I really want to hammer at this point home. To be sure you're looking at a real pattern, you absolutely need at least 2 touches on that top line. So 2 higher highs and at least 2 touches on the bottom line, 2 lower lows. That's the bare minimum. Anything less, and it's not a confirmed pattern yet. All right, enough theory. Let's see what this looks like in the real world. We're going to break down a classic example and see how this whole thing unfolds piece by piece. Check out this chart. Now, at first, this might have looked like a simple double top, which is a pretty common pattern where price hits the same high point twice. But instead of the price falling after that second peak, things got way crazier. The battle just intensified, and the whole price range started to explode outwards. The whole story of this chart comes down to that one phrase: higher highs and lower lows. Every time the sellers managed to push the price down, the buyers charged back in with even more force, thinking they got a discount, and drove it to a new high. But right at that new peak, the sellers came back even harder, driving it to a new low. It's this vicious cycle that gives the pattern its shape and its power. And this chart just lays out the whole story perfectly. You see the first couple of peaks, then a lower low, then an even higher peak, followed by an even deeper low. Every swing is wider than the last. You can feel the tension building until, bam, the buyers finally win the war. The price smashes through the upper trend line, and that whole period of indecision is over, kicking off a powerful new upward move. Okay, so spotting the pattern is one thing, but what happens next? What can you actually expect once one of these things breaks? Now, we're going to get into the hard data and see what the numbers say about performance. This is the question on every trader's mind, right? Is this thing actually reliable? Does it lead to big moves? Well, let's find out. Let's start with a number that might actually blow you away: 3%. In a bear market, when a broadening top breaks to the downside, the break-even failure rate is just 3%. That means 97% of the time, the price doesn't just stall, it keeps falling. That is an incredibly powerful statistic for that specific market condition. But, and this is a big but, context is everything. The pattern behaves differently depending on the overall market. In a bull market, an upward breakout is usually just a continuation of the trend. In a bear market, though, it often acts as a big reversal pattern. The big takeaway here is this: trading with the fro of the bigger market trend tends to give you better odds. So how big are these moves we're talking about? Well, on average, an upward breakout in a bull market shoots up about 29%. A downward breakout in a bear market drops by an average of 20%.
These are not small changes. It shows that once that volatility and indecision finally break, the move that follows is often pretty powerful. Now this is a fantastic little tidbit from the research, a partial decline. What does that mean? It's when the price starts to fall from the top trend line but doesn't quite make it all the way to the bottom one before it turns around and heads back up. When you see that happen, it's a huge clue. It correctly predicts an upward breakout over 70% of the time. It's like the sellers are running out of gas, giving you an early hint of who's about to take control. Okay, so we know how to find the pattern and we know the stats behind it. Now for the million-dollar question. How do you actually trade it? Let's get into some practical strategies. So one of the go-to tools here is something called the measure rule. It's actually a pretty simple way to estimate where the price might go. All you do is find the height of the pattern at its widest point, subtract the lowest low from the highest high. Then, if you get an upward breakout, you add that height to the breakout price to get your target. If it breaks down, you subtract it. And you can see it right here on the chart. They measure the height of that whole formation, and then they just project that same distance up from where the price broke out. This is great because it turns a chaotic, volatile pattern into a trade that has a logical, defined objective. It gives you a real target to aim for. So let's just boil this all down into a few key tactics. You can try to trade the swings inside the megaphone, buying near the bottom and selling near the top. But because this pattern is so volatile, a stop-loss order isn't just a good idea, it's absolutely essential. And, like we just talked about, keep your eyes peeled for those partial declines. They can be a great early warning system for a potential upward move. And finally, here's one last really important piece of data to keep in your back pocket. While those upward breakouts tend to hit their price targets a pretty respectable 60% of the time, the downward breakouts are a lot less reliable. They only reach their projected target about 35% of the time. So what does that mean? It means if you're trading a downward move, you might want to be a bit more careful, maybe take profits a little sooner. And that really brings us back to the central question of the broadening top. It is the pure sound of the market screaming with indecision. So is that volatility a warning sign telling you to stay away? Or is it the sound of opportunity knocking at your door? The key is understanding its anatomy, knowing the stats, and having a solid plan. And that choice, as always, is up to you.